And I've seen quite a number of sort of Dr. Dooms who've said, well, there's going to be a market crash. Well, we know that, but when?
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm delighted to say that I'm joined today by Jonathan Guthrie. For 27 years, until 2024, Jonathan worked at the Financial Times, most recently as the head of Lex, the paper's daily investing column, and perhaps the most prestigious corner of that prestigious publication. That's a pretty good vantage point from which to see the truth about investing, which, as it happens, is the name of a brand new book that Jonathan has written. We're hoping to unearth some of those truths in our conversation today. Before that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments below. It really does help others find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Jonathan, a very warm welcome to the show.
Thank you so much for having me here. I really appreciate it.
You're very, very welcome. Why don't we start, Jonathan, with why you wanted to write this book now? Why is there a need for this book, do you think? And what made it the right time for you personally to sit down and write it?
Yeah, well, look, those are great questions. And at one time I pitched to a colleague, a very dry-witted Bostonian called Rob Armstrong, to do a book with him. Mm-hmm. And his response was, no, thank you, Jonathan. There are sufficient books. And I kind of get that. But at the same time, in the context of what I've written in The Truth About Investing, we've got a lot of people who need to make investment decisions who didn't before in the UK. A lot of folks used to have advice and don't anymore. We've got, I think, about 9 million people on platforms like Fidelity's execution-only platform, which I use myself. And then there's another 20 million or so who have DC pensions. A lot of the time they aren't making investment decisions, and perhaps they should. Yeah. So that's my official answer. Do you want the unofficial answer?
Yes, please. Yeah. Always, yes.
So I was coming to work one morning at the FT, much too early, and arrived at Cannon Street Station, which is right next to where we are at the moment, just down the road. And as I was walking across the concourse, there was a huge banner advertisement, electronic, saying, trade currencies like a pro. And there was a picture of a very cool guy, very nice suit. Obviously, this was what he was doing, presumably making lots of money. And I just thought, I'm not that guy. I shouldn't be doing intraday trading. And most of the people around me shouldn't be doing intraday trading either. There's another way, which is gradual and considered, and you keep a lid on your risks. And that's what the book's about.
Yeah. And I mean, I don't know if you can relate to this experience, but when you speak to people who aren't very familiar with the world of investing, they are utterly put off by many elements of it. The technical jargon, the sort of the way it's often presented. And my experience often is it's just a few key things explained. Suddenly the fog lifts and their wariness kind of can dissipate somewhat, right?
Yes, I think that's right. And a lot of the jargon is there for a reason. It's to keep people out, you know, and it's to let folks like us, maybe who see ourselves as bit as being financial experts, have a little bit of a kind of priestly aura around us. If you just use ordinary language, it all becomes a lot clearer.
Indeed, indeed. A quick word on Lex, a famous investing column. I'm sure many of our audience are going to be familiar with it. What overlap do you see, and in fact, what differences do you see between your old audience for Lex and the potential new audience you want to reach with this book?
Yeah. Well, I think there is a bit of overlap, but fundamentally, Lex is for professionals. It tends to be for C-suite people, without giving away too much about the market research, tends to be chief executives, finance directors at quoted companies, plus financial services people. Yeah. So quite a lot of professional investors, hedge fund managers, private equity, long funds, those sorts of things. Who I'm going for here are ordinary investors, folks who need to make investment decisions. It's not what they think about all day. They're doing something else.
Yeah, I think that's a key distinction. Okay, well, let's get into some of the areas that you explore in the book. I mean, the book covers all the sort of the areas of the a person might encounter when they sort of enter the world of investing. But there was a couple of really interesting chapters to me. You spend a lot of time talking about cognitive biases, how we think when we invest. and in fact how that thinking can often lead to bad outcomes and bad decisions. We don't need to go over all of them, but a couple really struck out to me, particularly in the context of 2025 and how we've been investing this year. FOMO, the fear of missing out, I feel is particularly relevant this year, and one that I can really relate to. Status anxiety, and what you have to say in the book about groupthink. You have this line. You say there is no immediate status penalty for being wrong if everyone else is too. I can relate to that. I wondered if you could explain all these a bit more, Jonathan,
Sure.
and how they might apply this year in particular.
So the two are connected, I guess. Status anxiety and fear of missing out are sort of intimately connected. And this is what you see with all these cognitive biases that we have as private investors. And just as an aside, people who are professional investors tend to have fewer of them. There's been academic research to show this. They are much better at adjusting for their own knee-jerk responses. So I think one of the things you have to do as a private investor is understand your biases and aim off from them a little bit. Just to go back to your question, fear of missing out and status anxiety, the example is the friend who says they've done fantastically brilliantly in a particular kind of investment.
Yeah.
And instantly you think, well, why didn't I do that? Or can I do this now? And you can charge into something at the wrong point. Maybe when the price is much too high. Example for me, saw an old friend, hadn't seen him for many years, went and had lunch. He said, I've done fantastically in property, Jonathan. Bought lots of houses a few houses anyway, in Hull and other places like that. I've made a lot of money, a lot of capital gains on them. And instantly I thought, why have I been messing about putting stuff in funds and buying stocks and shares and all this kind of thing when I could have done what my friend did? Yeah. Next time I saw him, he was very unhappy because he said, well, for some reason he'd bought a nightclub. He was exactly the wrong sort of person to run a nightclub. And he'd had to sell it and he'd made a very, very big loss on it. So what people say to you that sometimes triggers that fear of missing out is incredibly selective.
Yeah.
It's a little bit about boasting. It's a little bit about achieving some level of status. And it's also just about having something to say. So don't be influenced by it.
Yeah, the groupthink thing is very interesting to me. I was thinking this year, and this shows up actually in sort of conversations that we have with our clients. I think we sort of entered this year with markets feeling like they were quite high. Then we had this sort of moment around the tariff announcements, and these big drops, this big more than a correction actually. And I think a lot of people said, right, well, there you go. That's the market crashing. I'm out. And sold in quite a big way.
Yes.
And then have seen through this year those big gains come back, and they felt like, well, I have to get back on board. And it just feels this year has been sort of tailor-made to trigger a lot of these biases and a lot of the bad behaviours that we shouldn't have really as investors. And just your point about professionals sort of ridding themselves of these biases, do you think that's innate and that sort of goes with why they're in that sort of job? Or do you think they've learned something along the way? And what do you think, how does it apply to your own investing? Have you kind of rid yourself of these biases?
Right. I think that people have learned to do it. And there's also there's a Darwinian thing. Obviously, if you make a lot of mistakes as an professional investor, you stop being a professional investor. And I've known a lot of very successful professional investors, people like Bill Ackman and so forth, controversial figure for various other reasons, but he's had bad periods and then he's had good periods. As it applies to me, I try not to time the market. I'm very wary of doing that. I know I'm not very good at it. I think most people are not very good at it. I'm a gradualist. I invest over extended periods of time. I trickle money in. That reduces my timing risk. If I'm taking money out, I take it out in small slugs. You've got to be a bit careful about commissions, for example, if you're dealing in stocks, because obviously you have to pay commissions every time, and that reduces your return. But I try to avoid timing as an issue. And I've also tried to stop feeling sad when I sell a company. If I bought a stock or a fund and I have to sell out, then it doesn't worry me as much as it used to, because you can hang on for much too long.
Yeah.
And one hedge fund manager said to me about this, he said, well, the thing you've got to understand, Jonathan, is that when you sell a share, it doesn't feel sad. It isn't upset that you've abandoned it. It's just an investment.
Yeah, we do absolutely get invested in our own sort of decisions.
It's called the endowment effect. When you have actually made a decision to buy something, it has a value in your mind that's probably greater than its monetary value.
Yeah, and actually you talked about, is it... you're going to have to remind me of the effect, but where you basically compartmentalize different parts of your finances.
Yeah, this is mental accounting. You put things in different buckets and you don't look at the totality of your portfolio. For example, you might have some UK stocks or UK funds, and they're completely separate in your thinking to what you're doing in the US. You really have to think at a total level how you're doing. You might be really screwing up in UK stocks and doing better in US stocks, but you need to see it as a totality.
So does all that mean, or does it lead you to conclude that for most small investors, the very best thing they can do is remove active decisions as far as they can, invest automatically on a regular basis into passive funds perhaps? Is that really where that approach leads you?
I think it depends how much money you've got, right? I think that the utility value, there's this thing, the utility value of money, which is it has different levels of value at different times. For example, if you're a young couple and you've got kids, you're a bit short of cash, money has quite a high utility value. If you've got lots and lots of savings, you're an older person, another few £1,000s here or there probably mean less to you. They're probably a bit less important. So I think if you have a relatively small fund, passive is a good way to go. You've still got to make quite a lot of investment decisions.
Yeah.
It's probably not a good idea just to shovel your money into a world index because you'll have 75% exposure to the US and a very, very big exposure to NVIDIA. You might not want that. But I think it's a reasonable way of managing risk. If you've got a slightly larger portfolio, you are likely to want to, if you're interested in investment and you've got some knowledge of finance and business, you might want to invest 10% of that in individual stocks, 20%, take some risks, maybe use some of the knowledge that you've accumulated over the years to try and beat the averages. That's a normal human behavior.
Yeah, I think this actually can be dictated by some of these biases. I mean, for my own part, that sort of status anxiety of knowing that I'll take a loss as long as everyone else is taking it as well.
Yeah.
What I really don't like is losing money because I know it's down to my own personal decision.
Yeah.
And it often leads me to passive investing for no better reason than that.
Yeah.
It's just sort of what I am most comfortable with. Okay, there's many insights in the book about the financial industry. And I'm wincing as I ask this because we're sat in the bowels of a large asset manager and a large investing platform as well. What have you garnered over the years being up close and personal with the investment industry? And what are the things that small investors should be aware of when they come into contact with it?
I think when you're dealing with financial services as an individual, friendly skepticism is quite a good state of mind to have. You need to think carefully about the claims that are being made. You have to think carefully about the selectivity of information that you're presented with. So, for example, some investment managers, hedge funds, particularly private equity, you may find that the returns that they claim are very selective. For example, they don't include funds that they've closed because they weren't doing very well. That bumps the average up. When you're listening to companies promoting themselves in various ways, you've got to be quite skeptical about the messaging. The old rule that I became very familiar with in all my years of being a City columnist and then running Lex was that chief executives would usually claim credit for external factors that had improved performance, and things that had gone wrong, they would blame on external factors. So there's that sort of blame avoidance thing. And it's always worth thinking, what does the money want people to do? What are the economic biases of the actors that you deal with?
Indeed. And you spend a lot of time in the book talking also about market crashes. This is on the mind of people right now, with markets being at quite a high level. What have you learned over, I think you say you've seen 5 crashes during your sort of professional life. What's the lessons that you've learned from those?
Yeah. So I think what I've come away from it with is a particular belief. And this is something which you can also find in the writings of market experts, much more intelligent and much more versed in all of this than me. People like J.K. Galbraith, people like Hyman Minsky. And it's that markets are innately unstable, that they tend to totter upwards because it suits everybody, because you tend to get paid more if you're a financial professional, if you have high valuations. You're taking essentially a sort of percentage cut of those high valuations every year. And then at some point, the music stops. So markets are going to crash. It's very, very hard to time when that's going to happen. And I've seen quite a number of sort of Dr. Dooms who've said, well, there's going to be a market crash. Well, we know that, but when? And you wait 2-3 years, they lose their job. And then after a year, you see the market collapse. So this is something you should expect. It's difficult to know when it's going to happen. And what you should do is have a strategy that allows for that. And that's long-termism, because over extended periods of time, for example, equities tend to deliver fairly stable returns, 7%, 8%, something like that. Individual years are hugely volatile.
And just finally, I wanted to ask about a change of mentality, if there is one, that happens around retirement, because it would be great. I think we can all see the logic of staying invested, but actually that money's there for a purpose, ultimately, for many people. It's going to be to provide income and to live from.
Yes.
And so those are kind of crystallization events.
Yes.
Do you think the mentality does change, should change at that point when you move into sort of decumulating assets?
Yeah, 100%. I think that the old idea that we had, particularly in the UK, was you retire, you get your pension from the big employer that you work for, and then it's locked in pretty much. In the private sector, you're exposed to the risk of the sponsor having trouble, but there's a whole lot of insurance against that these days. Nowadays, if you're in a DC arrangement, you don't have to buy an annuity. An annuity purchase is a massive timing risk of doing it at the wrong time. If you did it a few years ago when interest rates were a lot lower. The best thing that you can do is to decumulate gradually, to move out of, assuming you're in good health, assume that you have a reasonable length of time in retirement, and that you're going to reduce your exposure to equities over time. You may at some point buy an annuity and still have some investments. Do things gradually, do things in stages. Yeah. It all reduces your risk and maximizes your returns, potentially.
Fantastic. Well, we've covered absolutely loads there, Jonathan. So let's leave it for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means that you'll get updated content as soon as it is released. Give us a like, share the episodes. It really does help people find what we're doing here. And if you're interested in Jonathan's book, The Truth About Investing, and you should be, then we'll include a link for that in the show notes. That all said, Jonathan, thank you so much for joining me.
Thanks. It's been a pleasure.